Welcome to my YouTube channel, Data and Finance for All. This is Soham, and I came with another video where you will be discovering the practical finance tips powered by data-driven insight and smart analysis. So today we'll talk about systematic transfer program. In my last video, I put about SIP, systematic investment program. But in this video, I'm going to talk about STP, systematic transfer program. So these are the two very powerful techniques you can combine and can build your own portfolio. Before we proceed, please note that this video is based on my personal experience and analysis. Always consult a certified advisor before you take any financial decision. So let's dive into STP. So suppose you get some money from your bonus, office bonus, or you get tax return and you want to invest. You don't know what to do. STP is your plan. Okay. So there's one way you can just take that whole money and put it in a mutual fund or investment fund. Else, you can take that whole money and split it into two, 50-50, 6K, 6K. First 6K, you use it for first 6 months of a year. Take each 1,000 and then put it each month. And when it's happening, the rest of the 6K, you park it for a fixed income portfolio where you get a dividend or fixed interest rate. Suppose you get a 6% interest rate, right? For that 6K, by the time this 6K will be covered, you'll be earning a $200 interest each year, okay? So what happens when it's July comes? So you get the maturity from the rest of the 6K and you take it and you do the SIP. To complicate it, I'll show how it works. So scenario one, you got a 12K. Now you split it. 6K first month, 1,000 each month SIP. Second 6K, you put it in a fixed income and earn the interest rate. Use that money, then rest of the 6 month, then again you do SIP, 6K, 1K each month. Scenario two, you don't do anything, you just take that money and you just put it in one fund. That's it. We'll compare these two in an Excel sheet and try to understand if we invest this money in the same portfolio, where how much money you will be making, what are the differences are there. For simplicity, I used a ETF, exchange traded fund, which is represent the US total market. It's a Vanguard one. VUN is its code now. Code. I'll show the scenario for last three and a half years, how it will be moving if you invested in this way.
So now what we'll be looking at the data, the scenario we talked about. The first scenario is you take 1,000 each month from that 6,000 and you put in investment, right? So here I am showing the data that if you invest on that one, particularly that ETF Vanguard VUN, what will happen? So the data has the monthly data 2022 January to here is 2025 June. So the recent monthly data, right? So what is happening each month we are putting 1,000, okay? And then after 6 months, I was thinking it's suppose like you have this that 6,000 that is grown from the fixed income, suppose like a 6% APR. So you'll be getting 6,182 if you're holding in your hand. So that $182 you will be not getting there. So now you have $182 more in 6 months because you invested that one in a fixed income. Now you split that one for same split for the same even split for next 6 months. Now you are investing instead of 1,000, you're investing 1,030, right? For these last 6 months of the year. Then again go back to $1,000. Again go back to the basics. You'll be investing same. You are doing 6,182 on the 6th of the month. You'll be getting so on the 7th month you'll be investing $1,030, right? So this continues. Now what I have hit here is in this amount how much unit you can purchase. So last month you can purchase only 1238 because the price was $80.75. The second month you can purchase 13, a little bit more, 13.16 unit because the price went down 75.98. And then this shows the cumulative of the total amount. So what is that? That if you sum these two, then you will be getting this 25. Then if you sum these three, then you'll be getting this one. So it's a cumulative number, how much you are growing, right? So let's see what happens after almost 3 years actually investing. So you'll be having 512 share around 513 shares around there, right? And then if you go in that direction, then you will have almost invested 42,544, so around 42.5K, right? And then from that investment, the strategy, you make 55K, around 55.5K. So basically it's grown your portfolio 31%, right? But the the fun fact is when you are looking at when you started at the beginning, it's a 0%, but it went to the negative because the market, because it's still the COVID market was there, so the market was going down, the price was going down. So you can see that what of the value was there, the actual value, which is like total investment value, was actually going down at the beginning because of the market goes on ups and down and goes in a different direction. But then you see after a certain point of time when the market start picking up, and this is the benefits of doing SIP or like a consistently, that your investment actually start pick it up. You can see there, and then slowly it's 3%, 1%, 3%, 4%, and it's went up really high over here till 31%. What you started with only $1,000 each month, and now you are looking at total $42,500 investment. You're looking at $55,500, where like 31% you gain. So now look at the scenario two. Scenario two is, suppose you get a bonus February each month, each year, and you invest that one, same fund, and you do the repeated the same way. So see, that investment is coming on February each year. It's over here, 12K, and then unit you are purchasing. So basically nothing but you divide that 12,000 divided by unit price. So you'll be getting that unit purchased. So you'll be purchasing that unit till the same June 2025. So total unit purchase will be 562, and the other one was 512. So actually you purchase more unit than the other one. But the fun fact is here, you see that you invested $48,000 and you make $61,000, but your portfolio grown at only 27%. But you see the same pattern is also happening. At the beginning, it was negative because the market was negative. But if you believe on the consistency, that is the main key here. You'll be gaining over the time. So that is what you are seeing over here. Okay. So the next thing is the comparison. I'd like to show you the comparison between these two scenarios. I build a comparison of the percentage. So you see that at the beginning it started from the zero and slowly went down. In the both tool scenario, if you do the SIP, STP combination of SIP, or it's just SIP one time each time. So both has the advantage. You can see that it will be going up eventually. It doesn't matter how you investing, but then it's matter that how much one grows 27%, another goes 30%, like 31%. Let's put it that way. So there are 3 to 4% difference are there. Now you think about that you are talking about only 50K or 48K. But when you have a lump sum, a good amount of money and doing for a longer time period, so that will be actually a key difference from these kind of factor. More about this kind of concept, please like, subscribe, and comment below. And hope to see you in the next video. Thank you.